how much leverage is too much leverage. Maybe 2 to 1, 10 to 1. How about 117 to 1? Have a look here. Ridex total leveraged bull bear ratio for every $1 betting on a market decline. This is as of December 30. There was $117 betting on a rally, right? Perspective matters here. January 2022, the ratio hit 83 to 1. That was just before a 28% drop in the S&P. Ratio hit 103 to 1 at the start of a 21% S&P decline. This is a pretty reliable proxy for the balance of leverage in the financial system, and we have blown past the previous two extremes. There's a lot more to say about leverage in relation to the current wave structure. For more, go to elliottwave.com. You may remember the retail revolution in 2021. Well, the small traders are back. They're long and they're aggressive about it. The small speculator index from Sentiment Trader, it combines the net position of small traders in S&P futures, NASDAQ, and Dow futures. We hit 110 for the week of December 23. That is 161% higher than the retail mania of 2021. Wall Street Journal says these fringe players are now the dominant force, pushing around options markets, meme stocks, precious metals. They say it's not a passing trend. We think it is exactly that. Have a look here at some of the most speculative markets. NFT collections peaked back in August. IPOs in mid-September. October saw tops in BTC, meme stocks, SPACs. That buzz index at the lower left tracks stocks with positive social media sentiment. That one also topped in October. So this kind of to-the-moon optimism is rampant, but the impetus to gamble more generally may have turned back down. For more, go to elliottwave.com. Wall Street expects a rally in 2026 despite lofty valuations. Lofty here is a massive understatement. Have a look at price to sales in the S&P. We're nearly 50% higher than the peak of the dot-com mania, right? Compared to 2009, compared to a low in the market, $1 of sales costs 5 times what it used to. So what the bulls are really relying on here is called multiple expansion. They think investors will keep paying higher multiples for the same underlying performance. Our view is that these multiples have a natural ceiling. There's a terrific chart here from advisorperspectives.com. Bob discussed this one in The Last Theorist. It combines 4 valuation metrics, 2 types of PE ratios, the Q ratio and another measure based on regression. By these metrics, the stock market is 3.5 standard deviations above the mean. Again, for reference, the 2000 top, that peak came with this metric never reaching 3 standard deviations. The top in 29 was made below 2 standard deviations. Same with the top in the 1960s. Those were absurd extremes for the time. They led to major bear markets. We're deep into just insanity levels now. If you want to learn how we use sentiment gauges like this alongside wave patterns, go to elliottwave.com. Have we hit peak certainty on Wall Street? Bloomberg's year-end survey, every single analyst predicting a rally in 2026. There are no dissenters. Targets range from 7,000 on the low end, 8,100 at the extremes. Money managers, they're on board too. Bloomberg interviewed 39 of them. Only 3 were risk off, more than 3/4 risk on. This chart shows where the major investment banks line up. Rallies predicted across the board. Only question is how high. So stocks are going up. It's unanimous. Quick caveat, however, there is a famous precedent for this disappearance of bears. January 1973, Barron's famously reported not a bear among them. The Dow lost about half its value from 73 to 75. Pundits would later call it total annihilation. If you want to see how today's wave structure stacks up with the 70s, 80s, 90s, go to elliottwave.com.